Welcome back to Money Beast Mind. In today's episode, we dive into the fascinating world of behavioral finance. If you've ever wondered why investors make irrational decisions or why markets sometimes seem unpredictable, you're in the right place. Let's explore how psychology influences financial decisions. Investing is often seen as a numbers game, dominated by spreadsheets, algorithms, and financial ratios. However, beneath the surface of these quantitative measures lies a powerful, often overlooked force: human psychology. Understanding how our minds work, particularly when it comes to money, is crucial for making sound investment decisions. Traditional finance theories often assume that investors behave rationally, carefully weighing risks and rewards. However, in the real world, investors are not always driven by logic. Our emotions, biases, and cognitive shortcuts can significantly influence our financial choices, sometimes leading to irrational behavior and costly mistakes. Behavioral finance, a relatively new field of study, bridges the gap between psychology and finance. It seeks to explain how psychological factors impact financial markets and investor behavior. By understanding these behavioral patterns, investors can gain valuable insights into their own decision-making processes and potentially improve their investment outcomes. Ignoring the psychological aspect of investing is like navigating a complex maze blindfolded. While quantitative analysis is essential, incorporating behavioral finance principles can provide the missing piece of the puzzle, helping us make more informed and rational investment decisions. We like to think of ourselves as rational beings, but our minds are riddled with biases that cloud our judgment, especially with money. These biases are systematic errors in thinking that arise from our brain's attempt to simplify complex information. One common bias is confirmation bias, our tendency to seek out information that confirms our beliefs. For example, a bullish investor might only pay attention to positive news, ignoring negative information. Another bias is loss aversion, where the pain of a loss is twice as powerful as the pleasure of a gain. This fear can lead investors to hold on to losing investments too long, hoping to avoid realizing the loss. Understanding these biases is crucial for making more objective investment choices. In a world overflowing with information, our brains rely on mental shortcuts known as heuristics to simplify decision-making. While these heuristics can be helpful in many situations, they can also lead to predictable errors in judgment, particularly in the realm of finance. One such heuristic is the availability heuristic, which refers to our tendency to overestimate the likelihood of events that are easily recalled or vivid in our memory. For instance, after a market crash, investors might become overly fearful and avoid investing in stocks, even if the underlying fundamentals are strong. Another common heuristic is the representativeness heuristic, which involves judging the probability of an event based on how similar it is to a prototype or stereotype. This can lead investors to make poor decisions, such as assuming that a company with a charismatic CEO or a trendy product will automatically be a good investment. By understanding how heuristics influence our thinking, we can become more aware of their potential pitfalls and develop strategies to mitigate their impact on our investment decisions. Traditional finance models often assume that markets are efficient, meaning that all available information is reflected in asset prices. However, in reality, markets can exhibit periods of irrationality and inefficiency, leading to what are known as market anomalies. One well-documented anomaly is the January effect, which refers to the tendency for stock prices to rise abnormally high in January. While there are various explanations for this phenomenon, it suggests that psychological factors such as tax loss harvesting or investor sentiment might play a role. Another intriguing anomaly is the momentum effect, which observes that stocks that have performed well in the recent past tend to continue performing well, while stocks that have performed poorly tend to continue underperforming. This momentum effect challenges the efficient market hypothesis, suggesting that investor behavior such as herding or trend chasing might contribute to these price patterns. Understanding market anomalies is essential for investors because it highlights the limitations of traditional finance theories and emphasizes the importance of considering behavioral factors in investment decision-making. Section 5. The fear factor. How emotions drive investment decisions. Emotions play a powerful role in our lives, and investing is no exception. While rational analysis is crucial, our emotions can often cloud our judgment, leading to impulsive decisions and suboptimal outcomes. Fear, in particular, can be a powerful driver of investor behavior. During periods of market turmoil or economic uncertainty, fear can grip investors, causing them to sell their holdings and flee to the perceived safety of cash. This panic selling can exacerbate market downturns and lead to investors selling low, precisely when they should be considering buying. On the other hand, greed can also be a dangerous emotion for investors. When markets are booming, it's easy to get caught up in the euphoria and make irrational decisions, such as chasing hot stocks or investing in speculative assets without proper due diligence. The key to managing emotions in investing is to be aware of their influence and develop strategies to mitigate their impact. This might involve setting clear investment goals, sticking to a disciplined investment plan, and seeking advice from a financial advisor during times of heightened emotion. Herd mentality in finance. Humans are social creatures, and our desire to conform influences financial behavior. Herd mentality or herding behavior is mimicking the actions of a larger group. This can lead to buying stocks due to FOMO or belief in the crowd's knowledge. Herd behavior creates asset bubbles leading to crashes. The dot-com bubble is a classic example. Focus on due diligence and independent research to avoid herd mentality. Section 7. Anchoring bias. The perils of fixating on first impressions. Anchoring bias occurs when we rely too much on the first piece of information we receive. In investing, this can lead to irrational decisions. For example, fixating on the purchase price of a stock. To overcome this, challenge assumptions and seek multiple sources. Section 8. Overcoming overconfidence, taming the ego in investing. Confidence is generally considered a positive trait, but in the world of investing, overconfidence can be a dangerous liability. Overconfidence bias refers to our tendency to overestimate our abilities and the accuracy of our judgments, often leading to excessive risk-taking and poor investment outcomes. One manifestation of overconfidence bias is the illusion of control, where investors believe they have more control over the outcome of their investments than they actually do. This can lead to excessive trading, concentrated portfolios, and a failure to diversify properly. Another aspect of overconfidence is the self-attribution bias, where investors attribute their successes to their skill while blaming their failures on external factors. This can prevent them from learning from their mistakes and making necessary adjustments to their investment strategies. To mitigate overconfidence bias, investors should adopt a humble approach, acknowledge the role of luck in investing, and focus on process over outcome. Diversifying portfolios, seeking contrarian viewpoints, and tracking investment decisions can also help keep overconfidence in check. Section 9. Practical tips for rational investing, navigating behavioral pitfalls. Understanding behavioral finance is about developing strategies to mitigate biases and make rational investment decisions. Here are some tips. 1. Know thyself. Acknowledge biases and recognize their influence. Keep a journal of your investment decisions. 2. Diversify. Diversification mitigates risk and reduces emotional decision-making. 3. Tune out the noise. Focus on long-term goals. Investing is a marathon. Time in the market is key. Seek professional advice if needed. A good advisor can provide objective guidance and help you reach your financial goals. Section 10. The power of psychology, making smarter investment decisions. Behavioral finance is not about getting rid of emotions or biases. It's about understanding how they affect our choices and finding ways to reduce their negative effects. By recognizing our psychological weaknesses, we can make better, more logical, and more profitable investment decisions. The main point is that investing is not just about numbers, it's about people. By using behavioral finance ideas in our investment process, we can understand ourselves, the markets, and how psychology and finance interact. This knowledge helps us make smarter investment choices, avoid big mistakes, and reach our long-term financial goals. Remember, the best investors are not always the ones with the highest IQs or the most advanced tools. They are the ones who understand themselves, their biases, and the psychology of the markets. By mastering our own minds, we can unlock the true power of psychology in investing and create a more secure financial future. If you think this video is helpful, please like, share, comment, and subscribe.